235,000 jobs and another increase in the average hourly earnings, this by 0.2% month on month. Does it make a difference to the way the Fed acts this year in terms of interest rates? The market's already pricing in a near certainty that we could well see an interest rate rise come Wednesday, the 15th of March. Mike Ingram joins us now from BGC Partners. Mike, welcome. Anything you've heard in the last few days to deviate from the path that the markets are expecting this interest rate rise?
No, I mean, I think the bar was set extraordinarily high for this non-farm print, for instance, to derail the Fed's thinking. And the Fed has worked very hard to finally convince the market they're serious about a rate rise. So it would be a massive climb down for them. And ultimately the data doesn't support it. Yes, the bounce in average hourly earnings on this NFP print was a little bit weaker than expected, but it's still running above 2% inflation. We've actually seen as well inflation, market-driven inflation expectations. So, for instance, the so-called two-year break-even rates, that's the yield differential between nominal and tips, reach multi-year highs. So the Fed is also probably worried that inflation expectations might be starting to become a little bit disanchored. So they need to get rates up, and they're going to start doing it next Wednesday.
Is in the back of Yellen's mind anything to do with the fact that we've got an expansionary policy coming from Trump with this fiscal proposal? If he pumps an awful lot of money into the economy, that's got an opposite effect, effectively, hasn't it?
Yes, very much so. And in recent testimony, Yellen has said that she didn't particularly see the need for the US to receive any more fiscal stimulus, and she's also pointed out that the budgetary position of the US over the longer term is unsustainable. Now, they could have had the option of just waiting to see if these fiscal plans crystallize. But the problem is that makes the Fed hostage to fortune. They've got a dot plot of 3/4 point rate hikes implied this year. They risk themselves falling behind the curve if they're waiting for that kind of information. So I think they've basically taken a view. Well, the incoming data at the moment is looking strong enough. Let's get on, at least get 1/4 point hike in place next week. If Trump delivers in the meantime, then we will take another view.
And what's the likely effect of all this once the interest rate rises start to come through? Are you thinking that the dollar's going to be an attractive proposition, equity markets attractive proposition? Where does one go after the interest rate rises come from the Fed?
Well, I mean, certainly the first port of call is the dollar. If you take the view that over relatively short term, it's interest rate differentials which drive currency pairs. The market's already discounting something like 2.5 point hikes from the Fed this year anyway. As I said, the dot plot is currently 3. That, of course, is without really factoring anything that President Trump's administration might do. The market has only factored in 2 hikes for next year and 1 hike for 2019 against a dot plot of 3 and 3. So yes, we've come a long way from, interest rates are never going to go up, which is kind of where we were last summer, but we haven't really thought about sustained interest rate rises. To some extent, all we've done over the last 9 months is bring interest rate hikes a little bit forward. If they're indicating that they're not only happy with the trajectory that they indicated in the last dot plot, but that actually might be starting to inch up, then you're certainly going to see the dollar continue to be very well supported. You're going to see a bigger impact in the bond market. Obviously, you have seen some movement there as well, but you've not really seen it in the long end. As I said, the market's convinced this is all short-term interest rates rather than a longer-term trajectory. This will technically support equities because I'm going to lose money in bonds, all other things being equal. So where am I going to park it? Well, commodities aren't necessarily looking terribly clever at the moment. It'll go into equities almost by default. So you'll have a certain amount of technical support, as I say. The question always comes back to why are those nominal yields, why are these interest rates being raised? Is it because of growth or is it just because of inflation? And that's ultimately whether or not the equity rally that we've seen so far is sustainable. If it's just inflation, then it's on very shaky ground.
Of course, if the dollar goes up, then of course it puts earnings at risk. For the very
if you're an exporter, yeah, and obviously it may well put you under some pressure. Although a lot of the multinational companies have a very embedded, production. I mean, Apple famously, they go, well, how's Apple doing? Oh, well, let's see how Taiwan's doing, sort of thing. So it's not quite as clear cut, but yeah, there are a lot of moving parts on this one.
Okay, Mike. All right. Thanks very much indeed. Mike Ingram there from BGC Partners, taking a look ahead to the Fed interest rate meeting 6 p.m. on Wednesday evening.